The wait is over. On May 20th, SpaceX publicly filed its S-1 prospectus, the document that formally kicks off one of the most anticipated IPOs in market history. The company is set to debut on the Nasdaq on June 12th, targeting a valuation of $1.75 trillion. If it hits that number, it will be the largest public listing ever recorded. And SpaceX won't be alone. OpenAI and Anthropic are both expected to follow with their own IPOs before year-end. For the first time, three of the world's most powerful AI companies will be entering the public markets within the same calendar year, a convergence drawing intense scrutiny from investors, regulators, and governance experts alike. These listings represent far more than a massive transfer of capital. They will force a public reckoning with how these companies are actually structured and controlled. What's becoming clear is that the race to control frontier AI is being defined not just by epical vision and scale, but by a deliberate concentration of corporate control at the very top. All three firms have sought to govern cutting-edge technologies with custom-made rules, departing from contemporary corporate governance, the well-worn systems designed to thwart unfettered individual control through effective board oversight, risk-based incentive structures, and robust succession plans. Each company is, in effect, writing its own rulebook, and investors are being asked to accept that. To be fair, the founders' logic is not without reason. The global financial crisis revealed that most failing banks actually met the criteria for good governance on paper. Strong formal compliance proved to be no guarantee of sound decision-making in practice. That history gives founder-centric models at least some credibility. There's also a broader market shift at work. The recent backlash against heavy compliance costs and short-term market pressures, widely seen as a drag on innovation, has prompted a visible move towards founder-centric models. Investors are increasingly willing to back founders who can move faster and think longer term, but that willingness comes with real risks that are now coming into sharper focus. The first notable departure from traditional frameworks is the entrenchment of supervoting equity. Adopting the founder control model pioneered by Alphabet and Meta, dual-class share structures bypass the one-share, one-vote principle. Founders retain voting control despite owning a minority of the equity, in effect, silencing public investors regardless of how many shares they hold. In SpaceX's case, the numbers are stark. Provisions in SpaceX's IPO filings cement a structure granting Musk and other insiders shares with 10 times the voting power of ordinary shares, securing him a clear voting majority while holding 42% of the equity. That gives him an unassailable position on virtually every significant decision the company will face as a public entity. This will be combined with the use of SEC-permitted controlled company exemptions, provisions that allow SpaceX to forego an independent board of directors or a compensation committee entirely. That's a significant carve-out from the accountability structures that apply to most publicly traded companies, and one that further concentrates decision-making authority at the top. The second departure involves jurisdiction shopping and regulatory arbitrage. The turning point came in early 2024 when a Delaware court moved to void Musk's $56 billion Tesla compensation package on the grounds of weak board independence, a ruling that was later overturned, but not before it sent a clear signal about Delaware's willingness to scrutinize founder-friendly arrangements. The response was swift. Musk moved SpaceX to Texas and its director-friendly business court, a venue that offers directors substantially stronger statutory protections. It was a textbook example of regulatory arbitrage, relocating not for operational reasons, but to secure a more favorable legal environment. He subsequently merged xAI into the Rocket firm, completing a full vertical integration of his AI infrastructure under a single corporate structure. The broader context matters here. Because the scale of these listings is historic, American states and stock exchanges are actively competing to secure them, offering increasingly robust statutory protections to directors and skewing listing standards to accommodate tech giants. SpaceX is using this competition to its advantage at every turn. SpaceX plans to list on Nasdaq, which enables it to benefit from the exchange's new fast entry rule, allowing newly listed large firms to enter the Nasdaq 100 after just 15 trading days rather than the standard 3 months. That's a meaningful procedural advantage with significant market consequences. Once SpaceX enters the index, passive index funds are legally compelled to buy its stock almost immediately. This further weakens the leverage of active fund managers to extract governance changes, closing the window for meaningful investor pressure at precisely the moment it would otherwise be most effective. The third departure is the use of hybrid corporate structures. The anticipated IPOs of OpenAI and Anthropic may yet enshrine their novel governance architectures, designed to insulate their technical missions from standard venture capital incentives. The intention is understandable, given the stakes involved in frontier AI development, but the details of those frameworks raise serious questions. In October, OpenAI completed its restructuring into a for-profit public benefit corporation, in which the original non-profit foundation now holds a 26% equity stake. Although the foundation retains the legal authority to appoint and remove the PBC's directors, and thus the chief executive, the practical reality looks rather different. The intentional, significant overlap between Foundation and PBC board members, many of whom were installed following Sam Altman's reinstatement as chief executive, indicates that operational power lies increasingly with the CEO. The Foundation's formal authority remains intact on paper, but governance observers have noted the gap between that authority and its practical exercise. Anthropic has made perhaps the most creative undertaking to enshrine its safety-first mission into its corporate governance. Its long-term benefit trust enables independent experts to elect a majority of directors over time. On paper, it is the most thoughtful governance experiment of the three. The intention is clear: to build in a structural check that survives commercial pressure. But even under this model, trustees serve only one-year terms and must consult the CEO on appointments, an arrangement that creates an obvious tension with the independence the trust is meant to guarantee. More critically, a supermajority of shareholders retains the power to dissolve the trust without trustee consent. That's a meaningful override provision that fundamentally limits the trust's binding force. There's also the question of who actually controls Anthropic's capital. Amazon and Google each hold less than 1% of voting rights, a structure clearly calibrated to stay below antitrust thresholds. But together they have invested over $6 billion in the company, giving them real economic leverage well above 30%. They also provide the cloud infrastructure Anthropic runs on. The assumption that either would accept decisions that materially harm their commercial interests deserves serious scrutiny. The bottom line on Anthropic's trust structure is this: it provides an advisory guardrail, but the founders and their main backers, Amazon and Google, retain ultimate authority. The governance architecture, however innovative in design, does not fundamentally alter that underlying power dynamic. There is much to admire in these experiments. Corporate governance must always be evolving, and the ambition behind these structures is genuine. But they are entirely untested in situations with such high stakes for humanity. In a domain where the technology being developed could have irreversible consequences at scale, the risks of getting governance wrong are not theoretical, they are existential. The deeper irony is hard to miss. At precisely the moment when industries and governments are scrambling to engineer digital AI guardrails, many of their corporate governance equivalents have just been dismantled. The external regulatory frameworks are being constructed just as the internal accountability structures are being bypassed or weakened. The Musk versus Altman trial spent weeks interrogating the trustworthiness of AI's elite, only to be dismissed on procedural grounds. Yet it exposed a raw truth, one that the industry would prefer remained private. These historic IPOs and the humanity-impacting potential of their technologies now rest on the precarious scaffolding of a few founders' good intentions. Investors have noticed. Institutional groups, led by public pension funds, are lobbying for governance changes, including clauses to limit the duration of dual-class share structures. In the absence of such changes, responsible investors face a genuine dilemma, weighing the immense financial upside of heavily oversubscribed IPOs against the lack of independent board oversight and meaningful accountability. Governments and regulators should take notice too. Anthropic's Mythos preview last month showed that regulators are already struggling to keep pace with the technology. The hubris here is not in believing that transformative technology can be built. It is in believing that individual judgment is the appropriate final line of defense. Future AI rules must be designed with these corporate structures squarely in mind. Backstops must not be removed precisely when they are most needed.